Well, welcome to Investor in the Family Radio. This is Brian Bain, your host, and we're thrilled to have you with us again this week. And also thrilled to have David Reyes back with us. David, welcome.
Hello. It's good to be back.
For all of our faithful listeners, you know David has been with us throughout the 1970s of our Berkshire Hathaway letters to shareholders. I did it again, David. I didn't. We just talked about I'm going to read the cover of the book so that it's smooth. Berkshire Hathaway Letters to Shareholders by Warren Buffett. There it is.
There you go.
There's just there's too many words.
There is.
So Berkshire Hathaway. Sorry, go ahead. What? Go ahead.
It's a lot. I think they focus more on the content of the letter than the actual title of the letter. So that's good. At least that's good.
Yes. Well, I'm gonna read it. So welcome back for our series on Berkshire Hathaway Letters to Shareholders by Warren Buffett.
There you go.
It's a mouthful, but at least it's somewhat sensible. But David has been with us throughout the 1970s of this series, which has been great. And so he's back with us today. And today is the 1975 letter. And I was speaking the last, actually David he caught me. He said I guess last week he made a comment about, and he asked about what were the criteria that Buffett used to make investment decisions, like companies they were going to purchase or have some level of investment in. Is like, that's a great question. He's going to get into that specifically in either the 75 or 76 letter. And I'm looking, and I think I misspoke because I think it's specifically the 76 letter, which is next week. So sorry to...
Man.
I know. I'm looking at my notes. Maybe it actually is... Let me see.
Well, we have something to look forward to for next time.
Something to look forward to. I'm looking at it. Maybe it'll come up in here. I think what I was thinking about was the 76 letter, I think. Yeah. Anyway, but this 75 letter, this is like the 10-year anniversary for Warren Buffett. So let's give it a hand.
Yeah.
10 years for Warren Buffett at Berkshire Hathaway. Congratulations, Warren. You've done a great job. And let's read. Actually, I've been trying not to read straight from the letter too much because I imagine listening to that is probably not super fun. But I will read this because I think it gives some good context for where he's coming from. Let me see. And as I say that, did I get my weeks wrong again? Let me see. Oh, here we go. Okay, let me go. Okay. It says last year. No, I am off. That's next week's letter. I did it again. I apologize. Either way, so I guess technically next year is the 10-year anniversary.
Oh, okay, yeah.
Oh no, it's here. It's at the end. Okay, okay.
Yes.
Thank you for sticking with us, ladies and gentlemen. It's at the end of the letter, not the beginning. I was right. It is this letter, but I was looking at the beginning, but it's at the end. So let me actually jump to the end of the letter, and then we can kind of go back from there. Because at the end, he has a little section called General Review, kind of the way he's been over the last few years. He's been kind of segmenting the letter by business grouping, like insurance companies or banking or textile. But now he has a segment called General Review, and I'm just going to read this because I think there's a lot here. It says, your present management assumed responsibility of Berkshire Hathaway in May 1965. Hey, awesome. Now it's May 2018. How about that?
Hey, we're right here at the anniversary.
Yeah, exactly. Of course, this letter was written in 1975. But at the end of the prior fiscal year, September 1964, the net worth of the company was $22.1 million. And he talks about shares outstanding. Resulting book value per share was $19.46. So the year before they took over, Berkshire Hathaway was worth $22.1 million, and the book value was $19.46 per share. 10 years later, Berkshire Hathaway's net worth had been 10 years earlier. Okay. So basically in 1954, Berkshire Hathaway's net worth was $53.4 million. So it from like the mid-50s to mid-60s, Berkshire Hathaway went from $53.4 million down to $22.1 million, and that was before Warren Buffett came in. Okay, and then I'll skip through. There's some details we don't need to get into. This is in 1965. 2 New England textile mills were the company's only sources of earnings power. Okay. That's basically the core of Berkshire Hathaway was this New England textile mills. Before Ken Chase assumed responsibility for the operation, textile earnings had been erratic and cumulatively something less than zero subsequent to the merger of Berkshire Fine Spinning and Hathaway Manufacturing. So basically, okay. Since 1964, net worth has been built to, okay, remember, in mid 50s, net worth was 53.4 million. Mid 60s, right before Buffett came in, it had fallen to 22.1 million. Then after 10 years of Warren Buffett, the net worth of Berkshire Hathaway, drumroll please, was $92.9 million. Okay? Man. So it dropped from 53.4 to 22.1 the 10 years prior to Warren Buffett. With Warren Buffett, it went from 22.1 to 92.9. I mean, that's roughly a, what is that? I mean, that's almost a 5x, 4 or 5x return in 10 years. That's pretty astounding. And the stock price, book value of the company went from $19.46 per share to $94.92 per share. So pretty astounding growth in 10 years. So good job, Warren Buffett.
Yeah.
We're excited about how well you did from 65 to 75. Hope your success continues. He goes on to say, we have acquired total or virtually total ownership of 6 businesses. It's a great summary of kind of the last 10 years. They've acquired total or virtual total ownership of 6 businesses through negotiated purchases for cash or cash and notes from private owners. So they've basically bought 6 private businesses. They've started 4 businesses and then purchased various ownership. It says purchased a 31.5 interest in a large affiliate enterprise and reduced the number of outstanding shares of Berkshire Hathaway to the number that we don't need to read. Overall equity per share has compounded at an annual rate of slightly over 15%. So in summary, they've gone from the worth of the company has gone from 22.1 million to 92.9. Book value per share has grown from $19.46 per share to $94.92. They've bought 6 private companies outright. They have started 4 companies outright. They purchased a 31.5 interest in another company, and they've bought back a lot of their own stock. And their overall annual return on equity per share has been just over 15%, which is pretty fantastic. So that's a pretty cool, a pretty great 10 years, and also goes in a lot to, man, I'm talking a lot, so I'll give you a minute here, and David, I apologize. But, okay, in 10 years, he bought 6 companies, started 4, and bought part of another one. Granted, we will obviously acknowledge, as people who have been listening to the series know, throughout that time, they put money in bonds, they put money in different of their publicly traded securities. So there's been other smaller investments that have gone on, but those have been more kind of like side corollary stuff, kind of like putting money there while they're waiting to use it elsewhere. So think about in 10 years that bought 6, started 4, bought part of another one. How many investments do each one of us make in a 10-year period of time? It's probably more than 6.
Yeah.
But what if we had that level of diligence to think a great investment is worth waiting for? And I can jump at every exciting opportunity, and that's one of the biggest challenges sitting in my chair with the opportunities that I'm fortunate enough to have because of the contacts I have in the business and just research I have access to. I get to see a lot of great opportunities, or at least seemingly great opportunities, come in front of me on a regular basis, and I have to make the decision which ones are worth allocating my capital to. And it's really, really hard. Last week we talked about the challenge of having a good system for making investments, and I'm wrestling through that. What is my system going to be given my circumstances for filtering opportunities? I read what Buffett has here: 6 companies, bought 6, started 4, part of another one in 10 years. Man, what if I had even close to that level of discipline and scrutiny that I laid out for my investments? The fear is, man, well, how many great opportunities will I miss out on while I'm waiting, and researching other opportunities, and that's kind of that fear of missing out dynamic. But at the same time, how many mistakes am I making because I'm moving too fast as well? There's kind of a trade-off there, because in the long-term game, a few great investments can make everything for you. And so but the idea of finding a great investment without doing hard, great work is probably a dream we need to be careful of. It can happen, but without a good system and sticking to that system, it's probably going to be unlikely.
And I just feel like just just the constant chipping away. I mean, we saw in the last couple weeks just how it was just a really tough go round. I mean, there wasn't a whole lot of excitement when you had things that were not businesses that were not performing well, and just things that weren't really happening well. And so it's kind of nice to just see all this review over the past, the last 10 years at this point, and just to see all the work that has gone into it, not from, continually chasing the latest and greatest, but just chipping away at what is there. I think that's really astounding.
Yeah. And I mean, we talked last week a lot about the idea of the value of even us as individual investors writing an annual letter and on our investments and how they're performing, and being really honest with ourselves and kind of using those as benchmarks for growth and what are we going to do different the next year, and reflecting back on it. And even more regularly, just having investment journals, like just writing through what are we learning, what are we thinking through, how it's going well, what's not. It's kind of ways to benchmark our growth. And so it allows you to look back and say, hey, you know what? Right now we're going through a hard time because Berkshire Hathaway is in 1975. Like the letter begins. Like again, I got confused a while ago because I thought I wanted to read the beginning, but I wanted to read the end. Now I'm reading the beginning. He says, last year when discussing the prospects for 1975, we stated, quote, the outlook for 1975 is not encouraging, end quote. This forecast proved to be distressingly accurate. And he talked about, and he goes on to share some specifically numbers. He says this is the lowest return on equity experienced since 1967. And he basically goes on to say that the only positive thing for earnings this year was some federal income tax refunds.
Yeah.
So, and then he says the major variable, by far the most difficult to predict with any feeling of confidence, is the insurance underwriting results. So he's talking about, we thought 75 was going to be hard. It was really hard. And even now, our most significant variable, we don't know how to predict it for it. And so again, I just love, like you said last week, the humility and the honesty of Buffett in these letters, of being like, you know what, like things are bad right now, and being honest about why they're bad. A lot of times it's environmental or economic things they can't control. Sometimes it is things they can control. But he's like, hey, right now we've got a circumstance in our core bit, one of our core profit engines, the insurance companies. It's impossible to predict what's going to happen. And that's just the reality in investing. With investing, we are basically saying we're trying to predict the future. Okay? Yeah. Value investing reduces that as much as possible by saying right now this company is undervalued, is worth more right now than what the stock market is valuing it at. And so so in theory there's less future prediction going on there, but you're still assuming that you're right about the value and the stock market is wrong. And you're still assuming that the stock market will eventually recognize that value and then reward it by raising the value of the company, the stock price. But that may not happen. So even with value investing, there is a component of we're ultimately trying to predict the future, and that's impossible.
Mm-hmm. It's very risky. I mean, just all factors. I just feel like there's going to be a risk somewhere somehow. And I feel like that's unavoidable.
Right. And so the challenge becomes, first of all, being sober about what you just said. What level of risk are we okay with? And and then, what measures are we going to take to alleviate as much risk as possible? And it's important also to remember that while what you said is true, is yes, there is a lot of risk because you don't know what the future holds. But really, there's risk with whatever we do with our money. If you put your money... the whole proverbial stuff your money under your mattress. Well, there's a risk someone could come break in your house and steal your money.
Yeah.
There's a risk, maybe not a big risk, that that the American dollar, the U.S. dollar, will experience significant decline, and that money will be worth less in 5 years than it is now. And I mean, inherently, inflation does that anyway. So there's inflationary risk at a minimum. Or you keep the money in a bank. Well, there's inflationary risk there. Or what if there's other risks that come into play? So whatever you do, and then there's the opportunity cost. Like, okay, you quote unquote save that money. Well, what if you could have invested it and made a lot of money? Mm-hmm. So there's the risk of missing out on that. So there's a risk no matter what we do, and it's important to remember that even if we, generally speaking, the most conservative investments people think of out there are like passive index investing, where you put your money in an ETF, an exchange traded fund that basically is like a mutual fund with technically less fees, and it just basically it just follows whatever the broader stock market is doing, and that's considered one of the safest things you can do. But even if you did that, you would have experienced the dot-com bubble back in 2000, the stock market crash. The big stock market crash from 2007 to 2009 would have taken you down with it. There's risks there too. So there's risk with whatever we do. The challenge we have to decide is, what risks are we okay with? What risks are wise? What risks are foolish? And that's going to vary person to person. How much exposure do we want to any particular risk? Those are all the questions we have to be able to consider when making investing decisions.
Yeah, and I think it goes back to what we've been saying the last few weeks is just this constant evaluation that is going to really tell the story of kind of where we're at, where we're going, what risk can we take. And so I feel like those factors are going to help you answer those questions.
Right. And just as we, generally speaking, invest in our investment education, which is so crucial in my opinion, because the more we learn, the better investors we become, the more informed our decisions are, the more we learn of different alternatives, and the more we understand current alternatives, and we can make better decisions. Like it typically, I like to think of this kind of investment spectrum where on one end, we'll say on the right side of the spectrum is a solo entrepreneur. So someone who has started a business on their own, they have no employees, no shareholders, it's just them, right? Well, that person is basically as informed as that person can be about their business. Like no one knows more about the business than they do, and they are fully invested in that business. Because they're the 100% owner of it, right? That's the one extreme perspective on the right. On the left is another, I'll say, extreme position of someone who owns a portfolio of mutual funds, and all those mutual funds has like 30 plus 100 companies in it. And then you have like 25 mutual funds. So you're so diversified across the market that, 10 companies in there could go bankrupt and you won't even know the difference, right? So the risk level is significantly reduced there. And then there's everything in between. And what I feel like, in order to have confidence to move further down the right on that spectrum and become become less and less diversified, basically is the idea. In order to do that, we have to become more knowledgeable of that investment opportunity and have greater conviction based on real stuff, not emotion and excitement, but conviction based on real research and data and reasoning in terms of why we have high conviction that this asset either will experience great growth or is undervalued and will experience great value, or whatever the thesis is. And the higher conviction we have, the greater amount of capital we can have confidence allocating to that.
Yeah, and I feel like it all just takes work, and it's like a discipline. I think so. I feel like just everything that we take out of these letters are things that just require the discipline to do it, and they require the, just the patience and just all the things we've talked about. I feel like those are all just things that we need to just help us keep the main thing, but also just, basic life lessons of just like with anything is be patient. It's like, if you're going to risk, be smart about everything. And so I just feel like everything that we end up saying is just things that we just have to go back to ourselves on and just continue to work at it.
Well, and that's like we say regularly as well. A lot of things we're going to say in this podcast, it's probably going to be things that anyone who's investing for a period of time has been investing for a period of time, or anyone who's been listening to this podcast for more than a few weeks is going to be like, oh, I've heard them say that before. Oh, you said that last week. Well, because we needed to say it last week and we need to say it again this week. Because these concepts are usually not natural, and we're tempted all the time to betray these principles. And so by having regular reminders, it's helpful for you and I to stay on track, and hopefully for our listeners to stay on track as well, by catching ourselves like, oh, I'm slipping off. Because Buffett talks about, the two things that are going to set you apart as an investor is having a good plan, and then sticking to your plan. And most people never have a plan, and those who do don't stick to it. And so at a minimum, this podcast, I hope it will help us to stick to our plans, but also will help us to create great plans. And as far as having a great plan, we talked about, filters for what we will and will not invest in, and when we'll buy, when we'll sell. There's also the idea, too, of having a plan having a process for our investing. So, like, how much time are we going to spend looking for new ideas? How much time will we spend researching them? What will our research process look like? And also, how often are we going to step back? And I'll say, quadrant 2 time from Stephen Covey, The 7 Habits of Highly Effective People. Just a fantastic book. He talks about breaking your time up into 4 quadrants. And quadrant 2 is the quadrant where it's important things that aren't urgent. So basically, it's things that everyone ignores because we're always doing what's urgent and time sensitive, and so we end up not doing these things like long-term planning, evaluation. It's never urgent, but it's crucially important to do. We usually skip it because there's other urgent things we've got to do. So we've got to be able to say, you know what, there's this other thing over here that's urgent but not important that I've got to say no to, so I can do this important thing. And so how are you going to build that? And I'm totally talking to myself with this too. How am I going to build that into my investment process to have, for me, I think at least weekly reflection times to journal, to process how things are going, and to continue to refine my investment process to hopefully continue to get better and better results down the road.
Do you was at this point, and this is just kind of this kind of another question kind of outside this realm, but I was just Warren Buffett particularly. Obviously, like, he's known very well in the investing world now, just for what he's done and and we're reading his letters, things like that. But he's also known in the outside world as just being like the wealthiest man, right? And so it was at this point in the 70s. Was he kind of already at that point, at that caliber, or was it not at that point yet?
It's a great question. And it's one of those questions where I'm confident someone listening right now is like, I know the answer. And technically, I'm not sure. I don't think Warren Buffett started experiencing fame on a wide level. I don't think it's until probably like the 80s, most likely. Okay. I'm actually going to Google something
because I know it's easy to look at this and you're like, oh, it's Warren Buffett, but and just be curious. It'd just be interesting to know how Warren Buffett was Warren Buffett at this point, if that makes sense. I mean, I feel like just was he, I don't know. It's interesting to see because maybe he didn't have I don't know. I mean, you obviously have the resources within the, investments that he's doing, but it'd just be interesting to see.
Well, I'm looking at, I pulled up some charts, and these are all by age and not by, okay, because basically you can look at, there's a bunch of charts online there's tons of stuff on Warren Buffett online, obviously, but I just did a quick Google search on Warren Buffett's wealth graph or wealth growth timeline. And this will probably speak into it a little bit. And this one, let me pull this one up right here. Okay, it says at age 14 he had $5,000, and this is moving forward. At age 26, $140,000. 30, he became a millionaire. At 43, he had $34 million. And then at 52, he has $376 million. But then at 59, he had, so at 53, $620 million. 56 was $1.4 billion, so that's where he crossed the billion threshold in his early 50s. So it wasn't until his 50s that he became a billionaire.
Yeah.
And then 56 to 58 goes from 1.4 to 2.3. And then 59 he had the number's small, I think it's 3.8 billion in 59, okay? So from 59, 3.8 billion to 66, 17 billion. Okay.
Wow.
And then 66, 17 billion to 72, 36 billion. Then 72 to 83 goes from 36 billion to 58 billion. So it took him, let's say from the age 21 to 50, he goes from 20 grand. I don't know how they have these exact numbers, but they have 20 grand in 30 years. He has 376 million. That's a lot, okay? But then in basically 30 years, so those 30 years he goes from 20,000 to 376 million. The next 30 years he goes from 376 million to 58 billion. And if you can see this chart, the line just skyrocket. I mean, it's like nothing existed before the age of 55 wealth-wise, but after that it's just off the charts. So obviously, and I think his fame obviously on some levels corresponded to that a little bit. So I'm thinking it was probably the 80s when he started becoming more well known. That's my
it's definitely
memory.
it's definitely interesting to kind of read that with that knowledge of, hey, it wasn't where Warren Buffett is maybe now. It's kind of, he's just seen as, people refer to him as that, but he was just kind of, hitting the ground running with all of this stuff, just working hard every day on a lot of this stuff. So it is interesting to kind of note where he was probably at this time.
Absolutely, and that's really, a great way for even for us to wrap up this episode, because I think I want everyone to hear what David just said, because we look at Warren Buffett or any other famous person, we see where they are now, and we don't think about the 30 years, the 50 years it took them to get there. And so we think, oh, I can't do that. I was like, you know what? 50 years ago, Warren Buffett couldn't either.
Yeah.
And he didn't have this much wealth 50 years ago either. But it's a process. And it's like, I tell people from an entrepreneurial perspective, and I think it applies to a lot of areas of life, is when you get started, have a plan, and maybe a terrible plan, but have a plan and revise as often as you need to revise it. Try to get better somehow every day, and just don't quit, because everyone else will.
Yeah.
And the idea that we overestimate what we can do in 3 months and underestimate what we can do in 3 years. If we just get started and start moving forward, taking steps and getting better and better and better, and persevere, usually in most things we'll be able to see really great and encouraging results. But the thing is, that's really hard to do, and it's easy to think I can't be this blank person when, first of all, we shouldn't be trying to be that person, but there's a time when Warren Buffett was just some random dude, okay? And yeah, maybe he started investing. He's got a great math mind as a kid, whatever. We are where I am, and you are where you are. And right now, we can start taking steps to become a better investor. And we keep taking those steps day after day, month after month, year after year. And if we faithfully stick to a plan and continue to revise that plan as we need to, or completely overhaul, we work on getting better every day, and we don't quit, then the odds are highly in favor of us being in a place that we never thought possible years down the road. I'll put it that way. And so that's what I want us to walk away with today. So David, thanks so much for bringing that out. That was a great point. And so we'll wrap it off with that today. Thank you everyone for listening. It's been a blast. This was a 75 letter to Berkshire Hathaway shareholders from Warren Buffett. I didn't read it again, so I got off track. We'll be back next week with the 76th letter. So thank you, everyone. And David, again, thanks always.
Yeah, of course. And if Warren Buffett's out there listening right now, hey, let us know, what are your thoughts on this? It'd be interesting to hear. So we're, because you never know. He may be just wanting to invest in his investment education like we were talking about.
Well, it's funny you say that. Like, I actually, because I can't fathom that ever happening, but we actually have a good friend who, their hedge fund, the partners in their hedge fund, they went to have lunch with Warren Buffett like 3 weeks ago. They flew to Omaha, had lunch, and flew back. And I'm just thinking, can I just like sit at the table next to you or something? And they said it was an incredible experience. And I mean, I don't want to tell their story for them or that kind of stuff, but they said it was he genuinely is a remarkable human being, brilliant, fascinating person to talk to, and it's not like they just had a great time. So, but I wanted to be able to be like, can you just slip him this piece of paper and have him like do it, like listen to a podcast or give some feedback? But that didn't happen. Yeah. But anyway,
see, and I feel like if I would meet him, I'd be like, hey man, I really love what you're doing with Margaritaville. Yeah. I think you're doing a great job, with all that you're doing. I'd probably make a fool of myself somehow. So
it's like, hey Warren, I'm a huge parrot head.
Yes, exactly.
So cool. Well, with that, thank you, everyone, and we'll be back next week with the 1976 letter. Have a great week. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.